Good morning or good afternoon, depending on where you're located, and welcome to our fourth annual Energy Storage Conference, Battery Energy Storage in the UK and Ireland, discussion on successes and challenges panel. We thank you for joining us today. All attendees will be muted throughout the duration of this event. If you have any questions, we ask that you please submit them by clicking on the chat icon on the right side of your screen and typing in and submitting your question. Questions will be addressed by our panelists if time allots. And with that, at this time, it is my pleasure to introduce our moderator of this event, Francis EIE, a senior associate at K&L Gates out of our London, England office. Francis, please begin.
Thank you very much, Grant, and hi everybody. Thank you very much for attending this session. Just by way of an update on the format, what we intend to do is firstly introduce the panel and then go into some discussion points. And then, as Grant mentioned, if we've got 5-10 minutes at the end, give the opportunity to pose some questions to our panel of experts. So let's push on. Grant, if you don't mind changing the slides. The next slide. So let me introduce our first panel member. It's Justin Park of Hanwha Energy. Justin's a director of Hanwha Energy, having previously worked at LS Electric as a US country manager and overseas sales manager. He has over 15 years experience of developing and financing projects, including over 8 gigawatts of energy storage system projects and other renewables. And those projects have been developed mostly in Korea, Australia, Ireland, and Japan. Just a bit of so Hanwha Energy is a South Korean conglomerate, and it's a leading developer, investor, and solutions provider for energy projects in Korea and overseas. Hanwha develops, finances, operates cogeneration plants, battery energy storage systems, and hybrid energy facilities. Since its establishment in 2007, Hanwha has diversified its business and it's expanded overseas in a couple of jurisdictions, and it's now developing solar projects and smart energy system solutions, amongst others. So thank you very much for attending, Justin. Next slide. So our second panel member is Peter Kavanagh. Peter is the CEO and founder of Harmony Energy, which he founded in 2010, having spent 10 years or so in finance. He has over 12 years experience in the renewable energy sector, including financing and developing renewable energy projects. Peter is also an avid entrepreneur, also a director of Jones Food Company, Europe's largest high-care hydroponics facility, now majority owned by the Ocado Group. Bit of background on Harmony Energy. Harmony Energy was founded 10 years ago. It's now one of the UK's leading independent developers of utility-scale battery energy storage projects. Harmony Energy also develops, builds, and operates wind and solar projects for and on behalf of its institutional partners. And more recently, Harmony Energy has commissioned their first battery project in the south of England. And the second battery project is commencing construction this month. Harmony Energy also has over 500 megawatts of battery energy storage assets construction ready, with another 200 megawatts in planning, and has approximately 280 megawatts of solar power assets currently under development. So welcome, Peter, and thank you for attending the session. Next slide. And last but definitely not least, Phil Robinson of Habitat Energy. Phil co-founded Habitat Energy with his partners, having previously served as the head of commercial at Kavanagh Energy, optimizing a 2 gigawatt thermal portfolio. He was previously head of energy markets and credit risk at EDF Energy and a portfolio analyst at E.ON. So by way of background on Habitat Energy, Habitat is a market-leading energy services company actively trading UK battery storage assets in the wholesale and balancing markets 24/7. having been the second company to trade battery storage assets in the UK. Habitat also has a close partnerships with many of the biggest industry players, including developers and investors, supporting the design and financing of new build projects through its understanding of the revenue model and broader market dynamics. Thank you very much for attending, Phil. It's welcome to have you. So without further ado, let's move on to the discussion points. Next slide. So I sort of want to start the conversation on a positive note. Not long ago, it was confirmed that the UK has achieved over gigawatts of battery energy storage system projects, whether that's been grid connected or behind the meter. And in addition to that, there's a pipeline of north of 13.5 gigawatts. All of this to me is positive news, especially when you look at where we were as an industry 5 years ago. Some of that 13.5 gigawatt pipeline, some of the members of our panel today are actively participating in the development of such projects. So it's great to have you guys, and I guess where we can start is talking about your successes. Peter, I'm going to come to you first on this one because recently it was announced that Harmony Energy raised institutional capital from an investor, which is great. And also you secured a strategic partnership with an institutional partner in FRV. All of this whilst we're in lockdown, which is very, very good. So I guess, Peter, if you could please talk us through that process. Would love to know why you guys decided to raise capital, why you decided to look for partners, and what benefits do you think will come from that?
Yeah, sure. Thanks, Francis, and thank you for inviting me on the panel. Pleasure to meet everyone. So we started speaking to FRV probably 18 months ago. I guess we've been in the market for some time now. So we set up the energy storage side of Harmony 4 years ago. So it's been a long 4 years because, as many of the listeners will be aware, it's been a pretty tough market in batteries. There's a lot of talk in the media about them, a lot of hype. The reality has been, I guess, somewhat different in that finding funding and the right partners has been tough because of the merchant nature of the revenue streams. UK investors have been very used to long-term government subsidized contracts on big wind or big solar. So the battery market has taken a while to evolve. I think it's in a good place now. And we've got a strong relationship with FRV. What I can say that's in the public domain is we have 300 megawatts of our sites under exclusivity with them. And we have sort of over 200 megawatts that's available to develop out with other partners. And the approach we took is, there's obviously huge capex involved in these projects, which we couldn't do off Harmony's balance sheet, unfortunately. We've been a successful business, but when it comes to building out, these bigger sites, there's obviously huge capex, huge risk. So we did, without sort of saying too much about the arrangement. All I can say is it's structured around our belief of the market long term. So there's a lot of developers in the UK that probably want to sell out early, which is understandable. We took a longer term view in that we would rather have equity carries in the project because we really believe there's value in this market, and that value is going to take a few years to materialize. And that's primarily around debt funding in the market in the UK. And what we're seeing at the moment is that debt funding is in the range of 40 to 50% of the project value. And I think that's going to evolve, and it's probably more of a Phil question for later about how that revenue line is evolving. And it's really getting the banks and the debt funders more comfortable with the evolution of that revenue line. Because until this point, it's been it has been a tough concept for people to get comfortable with. But certainly, we're seeing a sea change, particularly in the last sort of 2 or 3 months. There's been we've had quite a number of approaches from different investors that are sort of entering the market, which people who weren't that keen in the last 3 years. So yeah, I think from our side, we've got a great partner in FRV on the first 300 megawatts. Very strong relationship there. They've been very good to deal with, and we're using Tesla batteries on the first 2 sites. And again, they've been a great partner in the early stage development. So that's sort of in a nutshell where we've got to. Does that sort of answer, Francis, where sort of?
Yeah, no, absolutely it does, Peter, and thank you very much for that. I think, firstly, given where you were when we first met over a year ago, and where you are now, it's not only an indictment of how well you guys have done as a company, but also like where we are as an industry and how it's moving forward. So huge congratulations for that. Peter, the other question I wanted to sort of drill down on is about these projects that you have, the 15 megawatt project that is grid connected in Dorset, and also I believe it's 34 megawatts that is about to commence construction in West Sussex. I was wondering if you could just quickly give us an overview of those projects, and also if you could talk about some of the challenges that you sort of experienced whilst developing those projects and how you've overcome those challenges. That would be great.
Yeah, sure. So, I mean, if I take them each in turn, so the 15 megawatt hour one, which is on the south coast, is a really good, nice little site. And the approach we took there was, it was our smallest site, so we almost wanted to develop it as a sort of test pilot project. And it's a very small footprint on an industrial estate. And I guess one of the concerns we've had as a developer, the problems we've had is, we've had some of these sites a long time. So that one we'd had sort of 3 years. And in the UK market, you typically have an option period with the landowner, because we don't own the land, we lease it. You typically have option periods of between 3 and 5 years. 5 years if you're very lucky, 3 years is more standard. So you've really got to develop out those projects within that 3-year time frame. And I think when we started out the business in 2016, we were very confident we were going to develop out these sites very quickly. It soon became clear that wasn't the case. It was going to be far harder than that. So I guess that that was a real sort of learning curve that we're trying to manage the expectations of the landowners and give them more understanding of the market, because obviously they're keen to get their rent payments, get the sites built out. In terms of the construction of the first site, it was all pretty straightforward. We didn't have any delays on stuff, barring a couple of items coming out of Spain and Germany. We're sort of 2 or 3 weeks late, but no major material delays. And those were sort of COVID-related delays because we were building throughout lockdown, because construction work was allowed to continue in the UK, and we had all sorts of safety measures in place on site, as you can imagine. So yeah, it was great to get it done when we're up against those sort of pressures. And it was a real learning curve for us in terms of, we've done obviously quite a lot of wind development in the past. So we know how the grid companies operate, how the metering companies operate, etc. So in terms of planning the logistics of the site, I guess, we've got an experienced team behind us that knew how other technologies integrate into the grid. And I think that's really important when you're operating probably in any market, not just in the UK. But yeah, having good relationships with the grid and the landowners is key. On these projects with Hulls Bay, the first project, we did have some issues with the grid initially, which were resolved. And I think it's a strength of the relationship you develop throughout the years of knowing the people at the DNO grid companies. With the second project, we're really pleased to close the financing on that and the EPC build out. So we're hoping we get that switched on by June next year. So it's quite a quick build out program for a big battery. So it's 34 megawatts, 68 megawatt hours, which is a much more exciting site for us. And it's the first one we're connecting into UK Power Networks, which is the biggest sort of DNO in the southeast of England. So yeah, very excited about getting that through. Again, challenges is around sort of, we were pretty tight on the option period of the landowner, so it's managing people's expectations around that. Negotiating the EPC contracts is always fun and takes far longer than you anticipate. But I think once you've done one with the same EPC, we've got a very strong relationship with Tesla, I'd say, and our first site was Tesla's first mega pack in the UK. The second site is their biggest in the UK. So it does make life easier. And again, that relationship's evolved over a long period. We've been talking to them for 4 years amongst other EPCs. There's a great selection of competition out there, both from a kit provider and a route to market aspect as well. So it's a sort of a good dilemma to have in the UK. There's a lot of strong competition because internationally the UK is viewed as a good energy storage market. So yeah, Touchwood so far it's been a good experience. No major horror stories yet, and you do inevitably in the history of things, you do have one or two projects which have lengthy delays. And we've luckily managed to avoid that so far.
That's brilliant, Peter. Definitely share your sentiments about negotiating EPC contracts and the importance of having a strong commercial relationship with your contractor. So definitely agree with that one. You, Phil, obviously, it's been in the press that you've recently gone live from a trading perspective on 2 fairly large batteries, especially when you look at it in the context of the UK. So I guess, obviously, given the services that you provide and the fact that, you come into projects a bit later in the life cycle, would love to get your views on how did you secure those contracts, first of all, and if you don't mind divulging. And also just what are some of the challenges you're seeing, in the balancing market right now? Great to get your views, Phil.
Thanks, Francis. Okay, so I think I would, echo some of the sentiments that Peter's already expressed about sort of how the industry works in the UK and the importance of relationships. So sort of whilst Habitat is a relatively new entrant, as founders, we've been working in it for a number of years and have built up a really good network and sort of understand sort of how to get things done. In terms of having the discussions with the asset owners, they're really interested to hear a coherent narrative for their investment that makes sense in relation to what they're actually seeing. So I think as an operator of batteries, someone who actually sort of dispatches them in the market, there's certain sort of credibility that goes along with what we're saying when it comes to revenue line items. Our approach has been to describe to potential clients the revenues that may have been earned historically by showing them some really detailed back tests where we effectively take the market data that was available to us as an operator throughout the period and sort of reveal that selectively to the model and show people how we would have made decisions at each point in time. So we can really construct the revenue line items almost sort of trade by trade. And in a market that is still evolving, that was, I think, pretty compelling at that point in time and allowed us to win some of the early contracts. In terms of our involvement in the balancing mechanism, when we founded the business 3 years ago, the balancing mechanism was always the intended destination of what we were doing. So unlike some of the players in the space who came more from, say, an ancillary services or an aggregator background, we always intended to go down the route of wholesale markets and always intended to participate in the balancing mechanism. And the reason behind that was that when we looked at all of the long-term forecasts of like how much flexibility was needed on the system, it was difficult to make the case that all of that was going to be, all of the batteries that were required were going to get their revenues from ancillary services, and you needed something much deeper. And whilst people might be looking for contracted revenues, it's arguably the certainty created by a deep economic need for flexibility that we were going to be banking on, and is arguably a bit more compelling. So we built our models to help us on that journey towards balancing mechanism. We went live in the balancing mechanism, as you said, sort of earlier this year. Even from day one, National Grid were instructing us. I think we had something like 80 plus instructions on our battery on the first day that it was operating, which, you know, they didn't exactly give us an easy start. You know, it was like go from 0 to full operation on day one, and we were able to cope with that, which was really satisfying. And I think the direction of travel from National Grid itself is around how to more actively use batteries via the balancing mechanism. So things like the reserve from storage trial that we participated in, conversations we've had around how the balancing mechanism might be reformed with them to increase participation has all been really, really positive. So, so far so good in terms of some of our initial working hypotheses for the business model actually coming true.
That's great stuff, Phil. I mean, I think firstly to know, I mean, given where you are now from when we first met during your Calon Energy days when I was negotiating your EMSA contracts, it's great to see that Habitat has grown from strength to strength and you're winning all of these contracts. So huge congratulations. I'm going to move over to you next, Justin. First, being up so late, it's north of 1 a.m. your time, so look, appreciate you taking the time. Obviously, as a firm, you know, we were involved in advising you on the development and construction of your 200 megawatt project in Ireland, which I understand is one of the largest portfolio battery projects in Europe, and definitely the largest in Ireland. So you know, it was great fun working closely with you and your team on that. I guess for the purposes of the audience, I would love if you could give an overview of that project. And clearly there were challenges along the way. If you could talk about some of those challenges and how you and your team navigated around those.
Francis, yes. Our 200 megawatt frequency regulations project is working well. No, actually, under construction, and because of the COVID-19, there are some the difficulties that we finish the commissioning on time. So we are actively talking with the all grid, and that they support us to finish the project as soon as possible. The biggest thing, the challenge actually was securing financial sectors because debt financing is very difficult in the island and London. So, but we made actually, fortunately, the Korea last 3 years, over 10 gigawatt hour battery were installed. So most of the bank very comfortable to the battery technology. So we actually invited the Korea Exim Bank, and then they gave us the debt financing. So that's the most challenging things, because usually when we have project in each country, we prefer the local debt financing, but the current situation is we have to invite some the Korean the bank here. So that was most challenging things. Also because of COVID-19, we have to provide some the video the due diligence things. It was a little difficult. Yes.
Yeah, I definitely echo your sentiments there, Justin. And actually, that segues perfectly onto the next discussion point, which is about the barriers that we're seeing to investment. So look, they're clearly positives. You know, we've got gigawatts now as an industry, so that's great. But I mean, I, I don't think, from my view, we are where we should be. Given this country's ambition, we're definitely not where we should be, and I think there's a reason for that. And most of the institutional investors that we talk to, whether clients or prospective clients, you know, their views are, you know, they've usually got capital to invest in these projects, right? But for one reason or the other, you know, they quite, you know, deploy. And I'd like to sort of start with you on this question, Justin, because obviously over the last 18 months, we've been working together on your market entry activities in the UK. But for one reason or the other, we've not quite been able to get a project past your investment committee. Now, obviously, I don't expect you to divulge too much as to the reasons why, but I'd love to get your views, and I think the audience would as well, on what you feel are the main barriers for Hanwha Energy in relation to investing in these projects in the UK.
I think, you know, Peter already mentioned, you know, some good answer for, you know, the questions. You know, the bank side only, you know, they prepared some long-term, you know, PPA contract until now. So they are, you know, they're not, you know, comfortable for this kind of, you know, the arbitrage, you know, the stuff, you know, right now. But Hanwha Energy, you know, the developing the few projects in the United States too. And then what we saw from, you know, the market is, you know, bank side is quickly, you know, the learning this, you know, the arbitrage concept, and then they feel, you know, the comfortable. So I think, you know, the UK situation will, you know, face, you know, the same thing, you know, the quickly. So I think, you know, anyway, my point is, and actually how to, you know, convince, you know, the investor for this, you know, the arbitrage in the market. I think, you know, there are two, you know, the big, you know, the challenge. First thing is technical side, and second side is stacking, you know, the revenue. I think, you know, we all have to, you know, the educate, you know, bank side. Technology is, you know, the ready to, you know, the commercial, you know, the operation, and also this revenue stacking model, you know, balance the mechanism and, you know, other, you know, the mechanism, you know, the, you know, comfortable, you know, for them. That's, you know, that we have to, you know, do together.
Completely agree, Justin. I mean, the conversations we had when we were obviously trying to assist with finding debt financing from your projects. I mean, we spoke to how many banks? 20 plus banks, and
yes,
there's clearly a desire, right? You know, they were all very interested, but when it comes to actually deploying capital, it seemed like they just couldn't get around the revenue stack amongst other considerations. So I think that segues me on to you, Peter, because you've talked about some of these issues, right? And it's not like I want you to repeat some of the narrative that you've mentioned, sorry, you earlier discussed, but, you know, how do we get around these barriers? I mean, we've got a pipeline of 13.5 gigawatts. I mean, that's going to be billions of pounds, right? You know, we can't simply rely on equity capital or, you know, investors like Hanwha having to go to the debt financing for these projects. How do we get lenders over the line on some of these deals? Because we know that there are one or two lenders that are deploying, like Santander and others, but how do we get the others to deploy?
Yeah, so I mean, there's sort of two major lenders in the market, so it's Santander and NatWest Lombard. And you know, like we've mentioned, the loan to values are pretty low, not that exciting. And I think the fundamental thing comes back to, again, they're used to long-term contract revenue streams. And with batteries in the UK, obviously we only have the only long-term contract really is capacity market. And that may make up, you know, a few percentage points of your revenue stack. So it's not overly exciting, 15-year contract. You can't really attribute much value to it. So it comes back really to what Phil was alluding to earlier in terms of, say, what Habitat are doing in the balancing mechanism. The balancing mechanism is a huge market, and it's a market that can take the volume of batteries that's out there in the pre-development stage. And it's really, it's still early days for batteries in the balancing mechanism. I think, sat here in a year's time, I think the conversation will be very different because the banks will have had a good year's worth of data from reputable traders like Habitat and others that are in the market. And people will be looking at that data and getting a lot more comfortable with it. But up until now, we haven't had that data. And National Grid, Phil can add to this point later on, but whilst they've been active, they still probably aren't calling the batteries in what we describe as merit order. And if they do, this market will really take off. And, we're confident when we look at the numbers that bank gearing, bank debt will become much more active in this market. It's almost been addicted to long-term contracts. And those, we know subsidies can't go on forever. It is frustrating when, you have the UK government coming out and announcing sort of how much money they're going to throw into green hydrogen and stuff. And, I think, again, that might come, but it's still hugely inefficient at the moment. I'm not asking for subsidies on the batteries, but, it's kind of a bit of a level playing field would be good. But I do feel confident that market will evolve just because the banks and the large pension funds are going to be sat on huge cash reserves, which they need to deploy, and they don't have the assets to deploy them in. So it always takes time for them to get comfortable, but I think we're at that sort of cusp of the market where we've got a little bit early, taken some risk, and hopefully that will be recognised and rewarded. Because I think if you're building out now, you do have an advantage to paying down the battery costs and trading more aggressively in the market. I think, the returns on batteries will be way more attractive than other renewable assets. If you looked at what people are paying to bid into offshore wind, for example, the yields, the premiums are extremely thin, wafer thin margins. And the batteries are more risk, but, there's a lot of products evolved in the battery market. We haven't touched on what we call floor products. So some of the energy majors are offering floors on longer term contracts, which makes debt funding easier. Harmony wouldn't look to use it because the floors are quite low at the moment and we don't think they're worth paying for. But if you really wanted debt in the battery, that is a route to opening up that market. So in short, I'm confident it will evolve over the next 12 months, but it's just not it's been quite frustrating. And like you alluded to, yourself and Justin have obviously approached a number of funders and had the same sort of conversations we've had, lots of interest, but no real substance behind the interest.
Completely agree with you, Peter. And I think that sort of segues me on to Phil now, because, we're talking about the balancing market being, a viable route to market for some of these projects, and obviously Phil, that's where you've got a lot of experience and you specialize. So Phil, in relation to the projects that had recently been grid connected that you are providing services to, would be useful to get your thoughts on, from a developer perspective, around some of the challenges or barriers that they've seen in terms of them investing into these projects. And also, if you don't mind me asking, just, I'd love to get your thoughts on whether, the balancing market really is the solution, and how we can get lenders comfortable.
Sure. So we definitely sort of see the challenges that the investor community has. We've probably got two people on the panel today who are the successful end of that spectrum. So a bit of survivorship bias. We've also been involved in a lot of processes that haven't progressed sort of as far as these guys. I'd say there's sort of three main areas that need to be overcome. We've touched on them a little bit. I think the first one is just a real basic level of understanding. And some of that depends on the background of the people involved. So as Peter was touching on, if you come from a solar background or a wind developer background, then you're sort of a little bit requiring some form of like subsidy, and if it's not going to be a subsidy, is it going to be a long-term deal? Is it going to be some contract you can do with National Grid, etc.? There are other people in the market, however, that have come from different backgrounds. If you've been in the UK power sector for long enough, people were building CCGTs, hundreds of millions of pounds a pop without needing, any of these type of support mechanisms. So, some of it's just a level of understanding and comfort with merchant-led models. And I specifically refer to merchant-led models because it's not that these models are exclusively merchant. They will, I would always consider as part of an optimization strategy ancillary service benefits, and can you do the long-term deal at the right effectively haircut to make it work. So but the ultimate way in which you value these assets is to return back to a merchant market and something that's liquid enough. The next area that I would touch upon, as Peter said, is just people needing to see a track record of returns in the sector. That's one of the key elements that gets people comfortable with the numbers that you're presenting. But tied into that question, I think, is the third area of problem, which is almost the inherent difficulty in forecasting the revenues from batteries. So the forward look of how much you can earn from these assets. And some of this, I think, relates to the way in which you construct the forward-looking models of how prices will evolve, across the investment horizon. Those type of economic models that the market advisors produce are typically like really good, or at least the best view, state of the art, being able to predict price levels. But because a lot of the battery's revenue depends on volatility, that is a much, much more difficult thing to forecast going forward, and hence is a much more difficult part of the conversation that you have with investors, getting them comfortable not only about price level conversations, but also the volatility aspect of it. And then I probably would just then take that and extend it a little bit further to talk about the level of debt in the projects. These assets do have an exposure to the volatility, and without being too glib about it, the volatility has volatility itself, and you can't really sort of hedge that in the marketplace to a large extent. So there is going to be an upper limit, I believe, on what is a sensible level of debt within any of these projects anyway, just because that's how the market's going to work. The volatility will depend on the supply and demand mix in any given year, weather conditions, fuel prices, et cetera. So I think debt is an important part of getting these projects away, but I think needs to be the right level of gearing.
No, completely agree, Phil. And you make some very, very good point. It seems like we will hopefully get there around some of these issues, and I guess it might just be a case of time. And the case studies from some of the successful projects that you guys are all involved in, they will hopefully set a precedent for other investors, lenders who are interested in this industry and who have to educate themselves. So grateful to get your thoughts on that. And I think, obviously we talked about barriers, but it'll be remiss of me if we don't talk about opportunities as well, because the fact that we've got a pipeline, as I said, of 13.5 gigawatts, that's an opportunity. Phil, I'm gonna come to you on this one as well. I would love to get your thoughts on what you see as the big opportunity in the UK right now for batteries.
Okay, I'm going to go, and again, I'm going to go for three, if I'm being a little bit cheeky there. So I think the first short-term opportunity, I think, relates to the dynamic containment product that's offered by National Grid at the moment. We have currently the largest market share of that dynamic containment product. It's extremely lucrative at the moment. Essentially, the demand for that product from National Grid is outstripping the potential supply. So there's a good sort of short-term opportunity for that. And definitely a recommendation to our clients is to, if you've got the chance of getting access to that, then you sort of do that as soon as you can. Our view on ancillary service markets more generally over time is that they will tend towards the opportunity cost of the merchant market anyway, as they become more saturated. So as National Grid introduces the new ancillary service products, it's really going to depend on the supply and demand balance at that particular point in time as to whether there's any additional profits to be earned from ancillary services compared to a wholesale market activity. Second element, I would say, is in relation to the balancing mechanism itself. As Peter said, the balancing mechanism at the moment is still imperfect. It still requires some sort of semi-manual interventions from National Grid to be able to select the appropriate units. And I think there is a question mark around the visibility of smaller assets on the National Grid side for meeting some of their own requirements. But the direction of travel for National Grid is undoubtedly positive. You know, they're working really, really hard to try to make batteries work and allow them to have good access to what they see as an extremely sort of flexible and valuable asset for the system as a whole. There are certain things that could be improved from a rule change perspective to make that even better for flexible assets. So things like changing the timing of gate closure relative to the start of the delivery period, would be one of those, and like how you declare your dynamic parameters to the grid, etc., and even shortening the duration of the settlement period. So we can be extremely flexible with batteries, basically flipping the direction from, say, a full charge to a full discharge in a fraction of a second, whereas at the moment the commercial frameworks don't really allow National Grid to access all of that flexibility in real time. And then the third area, which Habitat is investing a lot of time and effort in developing proposals for and our own modelling for, is the co-location of batteries with solar in particular. So batteries plus renewables is interesting more generally, but we see solar plus storage as sort of a real sort of boost for the economics of both elements of the co-location assets, and we're really enthusiastic about that one.
No, that's great, and I definitely share your sentiment on the last one, co-location opportunity, because certainly a lot of the developers we're talking to are really exploring this, and that sort of leads me on to pose a question to you, Peter, because we've had a discussion offline about the opportunities for utility scale batteries, and we've also talked about the opportunities for smaller scale batteries. So batteries that can provide services to corporates or industrials in terms of helping them manage their energy usage. In relation to those opportunities, Peter, I'd love to get your views on whether you think they are viable. And in addition to that, if you don't think they're viable, the standalone projects, what strategies would you implement to make them viable?
Yeah, it's a great question. It's a market we haven't been involved with, because we took a look early on when it looked attractive, because there were certain revenue streams you could deploy on those assets. It's quite a tricky market in that the size of battery when you're looking at those connections is quite small. So you're struggling to get the economies of scale, and you are still having to put in the same work in terms of the legals, securing the lease with a tenant on multiple different buildings. So it becomes quite a messy model. I think that there is a market for it. It's just how much you want to take on, really. Our preference is obviously what we call in front of the meter large scale standalone assets, because we think we get the economies of scale. we think it's going to be highly lucrative in the next few years, particularly due to the revenue streams Phil's alluded to. So we think now is the time and the opportunity to develop those large scale assets rather than small scale. But I think they definitely, the small scale has its place, particularly, and again, going on to what you both said about twinning solar and batteries. Standalone Harmony's looking at that quite a lot from the connections we have, and we're very excited about that potential because grid is a real constraint in the UK, and certainly cost-efficient grid can add a big number to the capex of a project. But I also think when you take that down to smaller scale stuff, the industrial sheds where you can have solar and batteries twinned, is pretty interesting. And that's, you mentioned at the start of the presentation, I was involved in a hydroponics business called Jones Food Company. We've put solar on the roof there. We're trying to get a battery on, but there's a slight problem with the DNO and the network in that area. But we are looking at, with Ocado, building out site 2 and 3, much bigger than the first site, hydroponic site, where we will twin with batteries on solar on a much larger scale. So I think those types of things where you've got particularly energy intensive business, it looks pretty interesting. The economics definitely work, but it's quite site specific. So with hydroponics, for example, it's very heavy energy usage. We switch off the lights in the hydroponics facility for only 3 hours a day, so 3 hours a 24-hour period. So that's maybe a bit unique, but yeah, generally there's definitely a business case for it. But for us personally, we're more focused on the larger scale opportunities because we think there's a more immediate opportunity in that space.
Perfect. Well, appreciate the insight, Peter. Moving on to a question to Justin, but this time focusing more on the Irish market. Justin, I know out of your portfolio, you have an additional 50 megawatts that is under development. We've discussed this quite a few times in terms of how you're going to position that project, whether you'll bid for a DS3 contract or whether you'll consider hybrid. If you don't mind, obviously you can't divulge too much about your strategy, but would love to get your thoughts on the hybrid opportunity in Ireland, given the success so far with renewables. Okay,
so Ireland to provide the capacity payment through the DS3 program. So that's, I think, the key to here. So probably the earlier of the following years, we're going to start the commercial operations through our 200 the megawatt battery energy storage. We still have around the 50 megawatt the grid connection. So what we're trying to do is actually we are looking for the two way. One way is we're trying to combine the synchronized condenser and the battery storage to provide the fully scale of the ancillary service, or we just combine the onshore wind plus the energy storage to provide more the energy to attend the energy the market. So I think there are a lot of possibilities that we can combine the new different the type of the energy and then make the more the revenue the stacking. So I think that's the key here, because in the UK for example, like we just focusing on balance of the market, and to make some perfect the policy, we need the time, and we need more the technology. But if we combine the PV, wind, or synchronous condense, anything to the the battery storage, and we can create the more the valuable things. I think that's the key way.
That's really interesting, and I think the antidote there at the end is that you're still open to investments in the UK. So I think if we've gotten anything from this session, it's that, Justin. So that's good to hear. So I think that's it in terms of the discussion points. I really just want to give some time to some of the questions that we received from members of the audience. And the first one is, can the panelists touch on the economics of battery storage projects they have worked on? What are the cost-benefit trade-offs? Please go to Peter on that one, and then I'll come to you, Phil, and then Justin.
So I guess I'm a little too early to say what the returns are on the batteries. I mean, I'm going to give you a wide range here, and apologies for that in advance, but we've only been trading since July. So, we are anticipating, over a 10, 15-year period, an IRR of about 15%. It's very broad brush. We're optimistic it will be higher than that. But, I don't have if you ask me in a year's time, we'll have a good data set to present. But that's the sort of region we're looking at in terms of making the economics on these projects work. The agreement we have with our funder is structured to give them protection, but I can't unfortunately say much more than that. Apart from it works for us because we're believing that the returns will be at the higher end of the spectrum.
Yeah, I think I get the gist there, Peter. That I'm very grateful for that response. So I'll go on to you, Phil. I'm grateful for your thoughts on that.
Certainly, like Peter will obviously have a lot better understanding of all of the individual line items that go into the investment case than I will. We're certainly working with a bunch of investors and developers who have similar sorts of views, targeting the same sort of levels. In terms of revenues, just to give people some idea, we're looking at sort of between 40 and 70,000 pounds a megawatt per year for a 1 hour battery. The range there is really driven by the volatility assumptions as much as anything else. So it's getting comfortable really with how do you evaluate the forward look of volatility and the peak off peak price spread during the course of the investment horizon. And what we have seen, I think that's been the real game changer over the last 18 months is the capex itself coming down. The competition in terms of the EPC has sort of driven the project economics into investable territory. The battery manufacturers have got a lot more flexible in the warranty design that sort of allows you to open up to all the different revenue streams, which is extremely important for realizing and making those revenue assumptions robust. And it's really been that sort of collective impact of capex coming down and people getting more and more comfortable for the about the revenue assumptions that's allowed these investment cases to start getting away and really gaining momentum.
That's a very interesting bit of analysis. Thank you very much for that, Phil. We've actually got another question, and I think it's quite suited to you, Justin, because it looks like it's a bit of a comparison between the UK and the US market. And obviously, I know that you've got experience developing projects in the US market. So the question is, how does the cost of electricity in the UK compare to that in the US? And I think the reason for that is the audience members trying to translate the economics to the States.
Okay, just I address these things. This is my personal opinion. Okay. Well, in the US right now is energy storage. Especially the battery energy storage is just the common sense to to everyone. So, for example, Kavanagh Energy must build at least the 3 gigawatt-hour battery within 2 years. So I think every the big the company faced the same situation. So as you can expect, choosing the amount the batteries that we can have the really the big discount the battery price. So probably right now is the UK and the the US the price the difference is about the 30 to 40% because of the battery price. So if, we cannot just, the compares, the apple to apple, but anyway, volume based. So US, has a lot of, the volumes we have to, to build. So we can get a lot of, the price, the discount from, the manufacturer. So I think, the big, the price, difference, there.
Thank you very much for that, Justin. That was a well put answer. I think that is it in terms of substantive questions, and I think on that basis we can probably close the session. Just wanted to say a huge thank you to our panel members, Peter Kavanagh, Bill Robinson, and Justin Park. Sorry, Justin, for keeping out till 2 a.m. But we appreciate your insights, and just a huge thank you to everyone who's attended this session, and I hope you got something from it. So on that note, I will hand over to Grant to close things out.
Thanks, Francis, and a big thanks to you as well for doing such a great job at moderating today's panel. Again, a big thanks to all of our esteemed panelists for delivering such an informative and interesting presentation today. And again, thanks to everyone in the audience for joining. With that, this concludes today's program. We hope that you enjoyed it. Have a great day or evening or night, and you may now disconnect.